While the Wall Street pundits scream sell and your neighbors panic watch their 401ks melt away, a group of savvy individuals are calmly collecting quarterly checks of over $1,800 in plain sight of everyone. How? They've zeroed in on 6 fortress stocks that don't just weather economic storms, they become even stronger in the face of adversity. These aren't obscure penny stocks or complex derivatives. No, these are household names hiding in plain sight. Financial titaniums disguised as everyday brands. They're the companies behind the products in your fridge, the pills in your cabinet, and the tools in your garage. But here's the twist. While most investors see only familiar logos, these savvy few see what they really are. Dividend compounding wealth-generating machines that keep churning out profits in bull and bear markets alike. Imagine scrolling through headlines of market crashes and recession fears and feeling a sense of calm, even excitement, because you know that with every economic tremor, your carefully chosen stocks are not just standing firm. They're positioning themselves for explosive growth when the dust settles. Sounds too good to be true? I get it. But after diving deep into market cycles, poring over dividend histories, and analyzing decades of economic data, I can say with conviction, these 6 stocks are as close to recession-proof as you'll find in the market. In fact, during the 2008 financial crisis, an economic earthquake that shook the very foundations of our financial system, several of these stalwarts actually raised their dividend payouts. While banks crumbled and retirement accounts withered, investors holding these stocks saw their income grow. Now, with economists sounding alarms about another looming recession, these 6 titanium tough stocks are more crucial than ever. Alright, so the first stock in our portfolio is JP Morgan Chase. With a current dividend yield of around 2.19%, investors can expect to receive approximately $4 per share annually. While this yield may seem very low, it surpasses the S&P 500 benchmark of 1.7% and pays you $400 in passive income annually. When constructing a dividend-paying portfolio, security is of utmost importance. A company's ability to consistently pay dividends is contingent upon its financial stability and ongoing operations. JP Morgan Chase's resilience during the 2008 financial crisis, when other institutions like Lehman Brothers succumbed to bankruptcy, is a testament to its strength. With its substantial cash reserves, JP Morgan is well equipped to weather economic challenges and continue rewarding shareholders with reliable dividends. What sets JP Morgan apart is its robust balance sheet, boasting an impressive $1.7 trillion in liquid assets with over $700 billion in cash. This substantial cash position provides shareholders with a sense of security, minimizing the risk of bankruptcy. In light of these factors, JP Morgan is a valuable addition to any dividend-focused portfolio, offering a combination of financial stability, growth potential in a rising interest rate environment, and a consistent dividend payout. The next stock in our portfolio is AbbVie, a prominent biopharmaceutical company with a diverse range of drugs in oncology, immunology, and neuroscience. August 10th, people may have never heard of AbbVie, and you may be one of them. That's okay. But I guess you may have encountered their commercial for the well-known drug Humira. Humira is a groundbreaking medication that effectively reduces pain and swelling associated with various forms of arthritis, including rheumatoid arthritis and Crohn's disease, as well as other skin disorders. Remarkably, it has consistently topped the list of best-selling drugs, with sales exceeding $19 billion in 2019 alone. AbbVie currently offers a dividend yield of 3.95%, translating to $5.64 per share annually. That means, if you own 100 shares of AbbVie, you're going to get $564 in dividends every single year, which is pretty compelling. The company's robust financial performance is evidenced by its impressive operating cash flow, which reached $22.9 billion in the most recent year. Given the controversies surrounding the American healthcare system, investing in a pharmaceutical company like AbbVie may raise concerns. However, AbbVie's strong position in the sector is underpinned by its leading patents on numerous drugs and its ongoing commitment to research and development. Before I reveal stock number 3, if you found the video helpful so far, could you please give it a thumbs up? It's a nonverbal communication that says you found value in my content. Alright, the third dividend-paying stock on our list is PepsiCo. Known for its diverse range of soft drinks and beverages, PepsiCo also owns well-known brands such as Gatorade and Frito-Lay, a consumer packaged goods company specializing in various types of potato chips. With a current dividend of $5.42 per share, investors can expect to receive approximately $1.355 per quarter for each share they own, resulting in a dividend yield of 3.2%. That means someone owning 100 shares of PepsiCo can expect to earn approximately $542 annually in dividends. One of the key advantages of investing in PepsiCo is its pricing power. Consumers consistently demand PepsiCo's products, allowing the company to maintain stable sales even in the face of price increases, as long as they remain within reasonable limits. This pricing power is particularly beneficial in the current inflationary environment. If PepsiCo can successfully pass on a portion of the increased costs to its customers without significant resistance, it will prove advantageous for the company's bottom line. Kraft Heinz Company, a well-known name in the food industry, is the fourth dividend-paying stock in our portfolio. The company manufactures and sells a wide range of popular condiments and consumer food staples, including ketchup, mustard, mayonnaise, and A1 steak sauce. With net sales of $26.6 billion in the previous year, Kraft Heinz Company has a significant presence in the market. The company offers a strong dividend yield of 4.83%, which translates to approximately $1.60 per share. Investing in a company that focuses on consumer food staples can be advantageous, as demand for food products remains consistent even during challenging economic times. People will always need to eat, which ensures a steady demand for Kraft Heinz Company's offerings. The fact that Warren Buffett continues to hold this stock in his portfolio is a testament to its potential value. However, among the stocks in the portfolio, Kraft Heinz Company warrants a closer look. In recent years, the company's profits have experienced a slight downward trend, albeit not drastically. This decline could be attributed to the growing shift in consumer preferences towards healthier food options, moving away from packaged and processed goods. As Kraft Heinz Company primarily offers shelf-stable products, this trend may pose a potential threat to the company's growth. While I am not currently concerned about Kraft Heinz Company's dividend stability, I will be monitoring the company's financial performance closely, particularly over the next few quarters to a year. If the company's financial situation does not improve, I may consider reallocating my portfolio and replacing Kraft Heinz Company with a different investment opportunity. Alright, pick number 5 is another controversial pick, but it's ExxonMobil. It may be considered a controversial pick due to its association with the oil industry and the global shift towards green energy. However, despite the long-term goal of reducing reliance on fossil fuels, the current dependency on oil remains significant. ExxonMobil is currently experiencing substantial profits and rewards its shareholders with a 3.27% dividend yield, equating to $3.80 per share annually. To put that into perspective, someone owning 100 shares of ExxonMobil can expect to earn approximately $380 annually in dividends. The pervasive use of oil throughout the supply chain, from food delivery trucks to agricultural machinery, further underscores the importance of the energy sector. Including ExxonMobil in your portfolio can provide valuable diversification and help mitigate the impact of inflation. However, it's essential to acknowledge the potential risks associated with investing in ExxonMobil. As governments increasingly prioritize green energy initiatives, the long-term viability of the oil industry may come under threat. The speed at which this transition occurs will play a crucial role in determining the future performance of companies like ExxonMobil. Despite these concerns, I believe that the global dependence on fossil fuels is unlikely to disappear abruptly, and ExxonMobil's dividend remains an attractive feature for investors seeking income-generating assets. Johnson & Johnson, the final stock in our portfolio, is a company that even Warren Buffett continues to hold, and for good reason. With a dividend yield of 3.21%, Johnson & Johnson pays out approximately $4.96 per share annually, which translates to $496 per year in dividends. The company